I believe one of the secrets to happiness in life is understanding that there are certain things that are outside of your control and certain things you can control, and to focus on those you can control. When it comes to the stock market, of course, we can't control whether it goes up or down. However, when it comes to taxes and saving money on your taxes, that is an area that you can control, which is why I like to really focus on that with my clients. My name is Joe Dowdle, and I'm a financial advisor at Worth Asset Management. And today I wanted to talk to you about donor advised funds and how they're a great way to lower your taxable income. And frankly, who doesn't want to pay less tax? Putting your assets in a donor advised fund is a golden opportunity to lower your tax bill. So what is a donor advised fund? Basically, donor advised funds are charitable giving vehicles administered by a public charity created to manage charitable donations on behalf of organizations, families, or individuals. Put simply, it's a tax-incentivized philanthropic savings account. You put money into the donor advised fund with the purpose of giving to the charity and let it sit there until you're ready to give. Now, there is a caveat. The caveat is that you can't take that contribution back once you deposit it into the donor advised fund. But this is actually good news because it means your assets are immediately tax deductible, even if it has yet to be given to the charity. Plus, even though those assets are technically no longer yours, you can still name your donor advised fund account, advisors, successors, and beneficiaries. Now, a common question is, what kind of assets should you contribute to a donor advised fund? The type of asset you contribute to that donor advised fund determines how much of a tax break you get. One popular option is publicly traded securities because you can avoid paying long-term capital gains tax on those securities and still deduct the fair market value of the securities. Let's look at an example. If you buy a security at $100 and put that into the donor advised fund, when it grows to $200, you get to deduct the $200 without paying taxes on the gain, which in this case is $100. Another popular option is to contribute a long-term capital gain property, like appreciated securities. This type of donor advised fund contribution lets you deduct up to 30% of your adjusted gross income. Now, the icing on the cake here is that once the assets are inside of that donor advised fund, they grow tax-free because they now belong to the charity. Now, certainly, donor advised funds can be complicated, but don't let complicated tax laws prevent you from donating to charities you care about. Donor advised funds are a smart way to lower your tax bill and donate to your favorite charity at the same time. Now, I am happy to visit with you and talk about your specific situation and whether or not a donor advised fund makes sense for you. Just go ahead and reach out and we can schedule a free, no cost, no obligation, 15-minute phone call. I can be reached at 469-423-1989 or email me directly at joe@worthassetmgmt.com or simply scan the QR code on your screen.